Every month you get a salary. Now it doesn't matter whether you get 10,000 rupees per month or 10 lakh rupees per month. What really matters is how do you manage this salary? And in my view, if you use one simple salary rule, you're going to build so much of wealth that nobody in your family would have done. So what is this salary rule? It's very, very simple. 25, 25 and 50. Allow me 2 minutes of time. Let's say, for example, your salary is 1 lakh rupees per month, which is the take home salary, right? 25% of this 1 lakh rupees, which is 25,000 rupees, you have to invest for your short-term goals. What are short-term goals? Short-term goals are any goals that you want to achieve in the next 5 years. For example, it could be that you are planning your wedding or your honeymoon. It could be, for example, that you're planning to add a baby in your family. It could be that you're planning to buy a house, therefore you need to make some down payment very, very soon. So anything that you want to achieve in the next 5 years, you have to allocate 25% of your salary into that. Now comes the second component, which is again 25. Meaning next 25% of your salary, which is let's say 25,000 rupees out of this 1 lakh, you need to invest for your long-term goals. What are long-term goals? Very simple. Long-term goals are those goals that you want to achieve after 5 years. It could be your financial independence. It could be planning for your child's education. It could be, for example, planning for your child's wedding. It could be anything that is beyond 5 years. And then comes the 50% component, which is the 50,000 rupees out of 1 lakh rupees you should spend for your life. You got to live your life. Now you may have a counter argument here. You may say that, Rahul, how do we live on 50% of our salary? You're talking about putting together all expenses, your home expenses, groceries, travel, Netflix, so much of expenses are happening. Well, here is what I would say. This is a broad framework, and depending on your personal circumstances, you could do some minor adjustments. For example, you might say that, Rahul, instead of 50%, I want to spend 60%, but then 40% remaining salary, definitely I can invest for my short-term or long-term goals. That is acceptable. But you come to me and say that, no, 90% of my salary gets spent. Now that is not planning. That is a poor management of your salary. And I can guarantee that if you're spending 90% of your salary right now, then you are not going to build a good financial future for yourself and your family. So please make sure that at least you are trying to save 40% of your salary and investing that either in the short term and long term. Now, speaking about short term and long term goals, there is a lot of confusion. Like there are so many instruments where to invest, right? People are putting money in FNOs and stocks directly for short term goals like 2 years, and they're losing their money. They're losing their salary. I don't want you to do that. I really want you to understand a broad framework. Again, I'm not going to give you any recommendations, but giving you a broad framework of where to invest your money for short-term goals and long-term goals. It is going to be super important video, full packed of learning. Every single minute you are going to learn something new, hopefully. With that intent, let me get this video started. Let me first speak about where do you invest for your short-term goals, which are 0 to 5 years. Broadly, I am going to categorize this into total 6 buckets, right? Depending on 2 factors. Factor number 1 is the risk appetite, because everybody has a different risk appetite, and second factor is the time duration. So what you see on my screen is 6 buckets here depending on your risk appetite and time duration. Risk appetites are conservative investor, balanced investor, aggressive investors, and time duration is 0 to 3 years and 3 to 5 years. So we've got total 6 buckets here. Let me speak about each of these so that you get a clear picture in terms of what are your options. So first one is conservative investor. So if you have 0 risk appetite and have no time whatsoever, then the options for you are fixed deposit, liquid funds, and arbitrage mutual fund. These are the options that might give you somewhere between 6 to 7% of annual returns. The risk is very, very low in these 3 products. It's not 0, but risk is very, very low. Now, FD is suitable for those people who does not understand anything about investing, do not have any time. They want to 6 to 7% returns. FD is a good option for them. Liquid fund, on the other hand, is useful for those people where they do not know when they would need to withdraw the money, right? Giving you an example, let's say if you do an FD with 7% interest rate for 2 years time period, right? But what happens after 60 days if you have to withdraw this money? You're not going to get 7% of interest rate. You're going to get rate which is 60 days, which might be, let's say, 4%, right? And on top, you might need to give a penalty. It might be 0.50%. So your overall return might be 3%, 3.5%, right? While in case of liquid mutual funds, there is no premature penalties as such. Whether you keep the money for 60 days or 2 years or 1 year, you're likely to get very, very similar annual returns of around 6 to 7% historically, right? Therefore, liquid funds is suitable for those investors where you don't know the time duration, right? I've created a full video on liquid fund topic. Please go and watch this video. You will understand everything about liquid mutual funds. Now, coming to arbitrage mutual fund. The main advantage of arbitrage mutual fund is the tax benefit. So if you fall under the tax category or bracket of around 30% or more than 20%, then these could be useful. Why? Because what happens in arbitrage mutual fund is that if you keep the money there for 12 months and make some profits out of it, then it is considered as short-term capital gain and you are going to be taxed at 20%, which is much better than your 30% tax bracket, right? If you invest this money for more than 12 months, it is considered long-term. Therefore, it's a long-term capital gain. Therefore, your taxes will be what? 12.5% as compared to 30% tax bracket that you might end up paying in FDs or liquid mutual funds. So arbitrage mutual funds is a very, very good category because it gives you a equity related treatment, but gives you safety and stability of debt mutual funds. So people who are into 30% of bracket, then this is a very, very good option in my view. Let me now move to balanced investor bucket. Balanced investors are investors who are looking to generate slightly better returns than conservative investors and are okay to take slightly higher risk than conservative investors. Now, if I talk about the 0 to 3 years time horizon, then in my view, you can go and explore corporate bonds. Now, why corporate bonds? So if you go to Wind Wealth's website, what you will note here is that they are offering around 9 to 12% of annual returns. Natural question is that why there is a range here, 9 to 12%? This is because different corporate bonds can give you different sort of returns because of their credit rating. So what you see on my screen here is that there are credit ratings like AAA, AA, BBB. And what you see on the y-axis here is the returns or the coupon rate or the interest rate. What you note here is that, for example, AAA credit rated bond, they can give you 7 to 8%. While you move to the right side, for example, AA, BBB, your coupon rate or your interest rate goes up. This is happening mainly because AAA rated bonds are considered the most safest bonds. While you move to the right side, your risk goes slightly higher and therefore your returns also go up. So here the beauty is that depending on your personal circumstances, you can decide how much of risk you want to take versus how much of returns you can generate. Second important aspect of corporate bonds is that it is suitable for those people who are looking for regular cash flow. For example, have a look at this bond. Again, not a recommendation here, but if you look at this bond here, it is offering you monthly interest coming into your bank account. So if you're looking for monthly passive income coming in your account, then that is one option that you can explore. Thirdly, in corporate bonds, you can start investing with as low as, let's say, 1,000 rupees. So that is giving you a lot of flexibility in my view. If you fall under balanced bucket and 0 to 3 years is your time horizon, you can definitely go and explore corporate bonds. I personally like Wind Wealth. Why? Simply because they invest 2% in all the listed bonds coming on their platform. So that gives me added confidence and that's why I'm an investor in Wind Wealth. Go and check it out. The link I've given in the description and the pinned comments. Let's now move to the next bucket, which is if you're a balanced investor and looking to invest for, let's say, 3 to 5 years of time horizon, then in that case, definitely go and explore index mutual funds or ETFs. And I would say that go for simple index funds like Nifty 50. For example, if you look at Nifty 50's long-term returns, it has given almost 12.82% of CAGR returns. These are very, very good returns. Now you may have a counter argument, Rahul, we are talking about 3 to 5 years of time horizon and you're showing us very, very long-term returns. Totally agree. What you also can see is the year-wise return. And what you would note here, so if you go back to last 20 years of Nifty's returns, what you would note is that if you look at any 3 years return, worst case scenario, you still get 8 to 10% returns. Best case scenario, you will get, let's say, 13 to 15% returns. For example, best case scenario, 2022, 23, 24. If you look at these 3-year returns, very, very good returns, right? If you look at, for example, worst case scenario, 2011, 12, 13, 2011, 12, 13, if you note here, maybe around 8 to 10% of average returns. Point is very, very simple. If you invest in index funds for more than 3 years of time horizon, 3 to 5 years, then you're likely to get around 10 to 12% of returns as per the past historical data. One important point I would also say here is that instead of Nifty 50, look at Nifty 500. Reason is very, very simple. If you look at Nifty 50, 40% of India's listed market is covered in Nifty 50, while in Nifty 500, you cover around 90% of India's listed market, right? Point number 2, if you look at the sectoral level concentration, Nifty 50 covers only 15 sectors, Nifty 500 covers 21 sectors, gives you much more better diversification. If you look at Nifty 500 stock level concentration, few stocks rule the Nifty 50. For example, HDFC Bank, ICICI Bank, Reliance Industries, they have a huge concentration as compared to Nifty 500, where one particular stock does not have huge concentration, right? So that gives you stock level diversification. And final point is that if you look at the long-term returns, right? Let's go back to 1999, 25 years of almost returns. Nifty 50 has managed to go up by 29x. Nifty 500 has managed to go 41x. That translates to 15.2% CAGR returns, while in case of Nifty 50, it translates to around 13.8%. But look at Nifty 500, very simple index. And if you're looking to invest for 3 to 5 years with a balanced sort of a risk appetite, then definitely go and explore indexes like Nifty 500. So hopefully that is useful. Let's now move to our third row, which is aggressive investors. So if you have huge risk appetite and you are happy with the volatility, then in that case, what are your options? Of course, you want to generate slightly better returns. So if you look at the 0 to 3 years category, I would still say that look at corporate bonds. Although you are an aggressive investor, it doesn't matter. You shouldn't be putting your money in equity, for example, or stocks or mutual funds. Why? Because the time duration is very short, 0 to 3 years. And if you get trapped into your stocks or mutual funds, you might not be able to generate returns. You might in fact lose some money. Therefore, 0 to 3 years, short-term duration, don't touch equity in my view. But when it comes to 3 to 5 years of time horizon, then along with index funds, you can definitely add direct stocks as well if you understand stocks, right? For direct stocks, please understand two important points. One is your risk appetite. You have to have very high risk appetite because huge volatility can be seen in stock market. And secondly, you need to buy time. So therefore, definitely if you're investing for less than 3 years, don't go for stocks in my view. But if your time horizon is more than 3 years, 3 to 5 years, then stocks become an option provided you understand how to go about investing in stocks. If you don't understand how to invest in stocks, please do not touch that asset class. You're going to burn your fingers, right? Where to start for stock investing? Start with this particular video I created on my channel, how to go about building a stock portfolio. I've given you a broad practical framework that will help you a lot. Also, you can consider joining my YouTube community. Almost on a daily basis, I'm speaking about various assets like stocks, and you will understand practically what is happening in the stock market, how to go about looking at valuations of particular stocks. So it will teach you a lot practically. Feedback of this community has been excellent. Simply go to my channel, find the join button and be my guest. So this pretty much sums up our short-term investment options. Let's now move to the long-term options where 25% of our salary can be invested for long-term. Here we are looking at three main buckets, right? Number one is conservative, balanced, aggressive, which is based on the risk appetite. And then you have time horizon, which is more than 5 years. Now in the last 3 months or so, I've done 20 plus podcasts and I've met top-notch people, top-notch investors, AMC CEOs and MDs, and one common thing everybody said for long-term investment is your asset allocation. Simply meaning that how you allocate your money to various assets and build a portfolio that will decide your returns over a longer period of time versus what mutual fund are you selecting, what stock are you selecting, etc. So asset allocation becomes very important when it comes to long-term investment. Now coming back to conservative first bucket, if you're a conservative investor, do not have much risk appetite, but because time horizon is on your side here, you're investing for more than 5 years, 8 years, 10 years sort of a time period. In my view, you can look at 3 asset classes that you can include in your portfolio. Number 1 is hybrid mutual funds. Number 2 is equity mutual funds. And number 3 is gold and silver. Now here, hybrid mutual funds, there is a debt component to it. Therefore, it will allow you to cushion your portfolio whenever market falls. While you have equity mutual funds that can slightly outperform the debt mutual funds, therefore the returns are likely to be better. And finally, gold and silver also act as a hedge in terms of portfolio volatility as well as rupee depreciation. So in my view, these 3 asset classes what you can explore. Now, if you're a balanced investor, meaning that you can take higher risk than the conservative investor, in that case, you don't need this hybrid mutual fund in my view because you're looking at more than 5 years of time horizon and you can only go ahead with index funds, equity mutual funds which are actively managed, gold, silver, global mutual funds, Bitcoin and large and mid cap category stocks. Now I'll just make 2 quick points here. Point number 1 is just because I've said Bitcoin here or global mutual funds here, it doesn't mean you have to have it in your portfolio. The qualification for you to have an asset into your portfolio has to be that do you understand that asset class? For example, Bitcoins. Now if you don't understand what moves Bitcoin price, please don't get into that game, right? This is an option. It doesn't mean you have to invest or have to have that exposure in your portfolio. Rule number 1 is always only invest if you understand what is driving that asset class. Almost 80 to 90% of the times you are able to gaze and judge where the prices are moving, right? Second important point is the entry price, right? Now entry price is what decides what are your returns likely to be in a longer time period. For example, right now taking entry in gold and silver, when gold and silver was all-time high, it could be very dangerous for your portfolio returns, right? In fact, I've done a very good detailed video on gold. Please go and watch this. I've done a similar video on silver. Please go and watch this video. They are going to talk about fundamentals, technicals, valuations, a lot of things that you otherwise don't get to understand. Please go and watch these videos. It will give you a good perspective. So that's about the balanced investor. Now let's move to the aggressive investor, person that can take higher risk. Somebody like me who is a very, very aggressive investor and looking at long-term investments. In that case, for us, sky is the limit. Index funds, equity mutual funds, gold, silver, global mutual funds, Bitcoin, unlisted stocks, all sorts of stocks, not just blue chip stocks, right? This is your universe where whatever asset class you understand, you go and invest in that asset class, but understanding has to be there. You cannot just blindly go and invest in, I don't know, cryptos, for example. You need to understand what is Bitcoin, how does it work, how does the halving work, what is Ethereum, for example, right? You have to understand all of that. Real estate is another example. If you're looking for long-term investments, and if you understand real estate as an asset class, definitely it makes a lot of sense for you to include that in your portfolio. So this is how you can plan for your long-term investments. But again, coming back to my original point of how to manage your salary. Please remember this rule of 25, 25, 50. The day your salary hits into your account, 25% for short-term goals, 25% for long-term goals, and remaining 50% you spend. Of course, you can do some minor adjustments into this broad framework. But as I said earlier, if you're spending 90%, 95% of your salary, then you're not building your financial future. If you like this video, I request you to hit the like button. Let me know in the comments a simple thank you. Also share this with your friends and family. I'm going to see you in the next video. Until then, keep rocking.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks, including delay and/or default in payment. Read all the offer-related documents carefully.